I was gambling in Havana. I took a little risk. Yeah! Send lawyers, guns, and money. Dad, get me out of this.
Well, welcome to our second podcast. I'm Ken Cyree, the Dean and the Chair of Banking here at the University of Mississippi, and we're honored today to have with us Charles White. He is the Managing Director at Stifel in Birmingham and a longtime supporter of the Banking Symposium. In fact, titled sponsor for quite a while and has really been instrumental in helping us do what we do, and just a great friend of the program and a personal friend as well. So thank you, Charles, for all you've done for us and been a great Ole Miss supporter. It's been a wonderful ride. So we're here today to talk about quite a few issues. There's a lot going on. This is April 2025, a lot going on in the markets. Right. But if you would, I'd like for you to give a little bit of perspective. You've had a long and distinguished career, and just talk about some things that you've seen that and then we'll lead into kind of the tumultuous, the title of your talk here being Send Lawyers, Guns, and Money from Warren Zevon. And for all the audience that doesn't know that song, they probably need to Google that and listen to it. It's maybe don't look at maybe keep it away from the
don't read the lyrics.
PG-13 and above maybe, but it's an interesting song for us old guys that know about it and funny. So we appreciate that. But if you could just give us a little bit of perspective.
Sure. Yeah, and really that title, came as a joke response. The email asking me what the title should be, right? But it turns out that it is, and of course that's kind of referring to the chaos that is in what you really think of as the financial business, right? Because it's everything. It's banking, it's equity markets, it's debt markets, it's currency markets, it's precious metals markets, and everything. And so that this turmoil has deep roots, right?
Yes.
And they go back a ways. You guys trained me in banking and finance way back in the early 80s. And since I left here, I guess in 1982, we've seen a lot of cycles that we've been through, but I think this one's different in a number of ways. And we can talk a little bit about that maybe, and then a little bit about, how we got here, because I think that's pretty important.
Yeah, when you think about your career in the 80s, and I remember too, interest rates were rather high. I think a lot of our people that I talk to that are in their mid-30s and certainly younger, they've never really seen an interest rate environment like this. They're kind of shocked when you say, yeah, back in the 70s and 80s that the prime rate was double digit and at one point approached 18%, there for a time. And it was very different environment. And a lot of what we saw with inflation the last few years, that was a part of it. But can you talk a little bit about kind of the evolution of markets? And I think in particular, too, not only technology, but the way that markets are now structured, people have, number one, a lot of different options to manage that risk, where we didn't have quite that many options back then. You also saw, I personally think leverage, people talk about, well, there's more leverage. I can't remember a time when there wasn't too much leverage. There's certainly been times where there's more than others, but I think we're almost always seemingly levered. But can you talk a little bit about the evolution of what you've seen in the markets? So we may as well just start back there and let's move forward till we get to these current tumultuous times. Maybe.
Sure.
Maybe that's the way to do it.
Sure. Well, it's so funny. In 1982, when I graduated, you really didn't have much perspective because it was the Fed wasn't nearly the household word that it is today. Sure. Which is a bad thing, by the way, for the U.S. economy. We're all better off if people that outside the financial business don't know who the Fed chairman is. However, that's not true today.
No.
But you're right. In 1982, 30-year Treasury yields were in the 14.5% range, and overnight rates were 18 or 19. Treasury bills were 19-ish percent. The yield curve was steeply inverted, obviously, like by 500 basis points.
Yeah.
And really what happened then was the Volcker Fed was trying to target money supply to bring down inflation. So cinch down the money supply, inflation will go away.
Yeah.
Now, we got a pretty good case as to how and why the reverse is happening today, we'll get to in just a minute. But they succeeded, but not without doing some damage, right?
Yeah.
And they really backed off in 1982 because of Mexico and the problems with the strong dollar because of high rates causing Mexico. Then they backed off again in 1984 because of Continental Illinois, the fifth largest bank, I think, at the time, was about to fail.
Which instituted too big to fail, which we're still, wrestling with even to this day.
That was kind of the beginning because everybody said, okay, why in the world does a small bank called Penn Square in Oklahoma, I know it affected Continental Illinois, but how does that affect everybody else at the time? Chemical Bank, Manufacturers Hanover, et cetera, et cetera. And of course, they're all interconnected. So, and that really kind of enshrined that concept. And that concept is obviously still with us today. But the Volcker Fed really, with the assistance, by the way, of a lot of other things, I think at the time, Reagan's tax cuts and whatnot, really broke the back of inflation, which really lasted until post-COVID, when you think about it. We did have 3% plus inflation in the 1990s, but you had an economy that was growing at 6% gross pre-tax inflation, non-inflation adjusted GDP growth, and the economy took it in stride, right? It was able to work. But now you really have today, the roots of the problem that we're experiencing today really go back, I think, to 1998. Sometimes I used to think, and a lot of people will say, in 1987, the first week of October, the Dow drops 503 points, which is a massive percentage amount at the time. I forget now. And Greenspan stepped up and said, hey, the Fed's here, right? In other words, we don't want this to bleed through to the economy. Well, that really didn't have to happen because, once they said that, markets rebounded, everything else. We had another sort of mild crisis in the real estate business in the early 90s. The Fed took rates all the way down from 9% overnight in 1989 to 3% in 1993. But that wasn't really a, quote, bailout. But then Greenspan raised rates in February. He did what Jay Powell and his group did not do in 2022, and that is get out ahead of the inflation. Greenspan did in 94. And you remember rates doubled. Short-term rates went from 3 to 6. Mm-hmm. And he started in February 94, finished like in early 1995. But the big change in the markets and the system looking immediately to the Fed was in 1998. Massive hedge fund called Long-Term Capital Management, levered to the eyebrows. Mm-hmm.
Which, by the way, that was professors that started that.
Every one of them. They were all academics.
Exactly right.
Some will say that's why it happened. But you're exactly right.
Yes.
They all had PhDs, right? Mm-hmm. And they was, one of them put it at the time, we're picking up pennies all over the globe. Well, the problem was they were right in front of a bulldozer where they were picking them up, right? Because the leverage that they had, you had a small currency crisis with the Thai baht that began to trigger and really kind of rippled to the Russian ruble. And all of a sudden their leverage cut the other way, right? That's why it's called a two-edged sword, right?
Yes, indeed.
As opposed to a cutting tool that only has one edge, right? Leverage has a two-edged sword. And, but here's the key is the Fed didn't bail out Main Street. They didn't bail out the banks. They bailed out the securities firms and investment banking firms in New York who had the same trade on that long-term capital had on.
Yes.
Cut rates 3 times, which really sort of lit the fuse on the internet bubble, mm-hmm. right? And so ever since then, of course, we almost lost Merrill Lynch in 1998. I mean, the stock was down like 80%. Everybody was worried that they'd burn up their capital, et cetera, et cetera. And then 10 years later, we did lose them.
Yeah.
Right. And leverage was the reason every time.
Yes.
So of course, 2008, if 1998 was, the beginning of the Fed put, so to speak, where the Fed steps in and bails you out, of course, 2008, was the giant example. It was the economy size bailout.
Yes.
And so post that, you had a policy at the Fed to really hurt the saver and help the leveraged borrower, right? And artificially, I think, kept rates down for most of a decade.
Yeah, real rates were negative for years.
Exactly.
Especially on the short end of the term structure. Anything around 10 years or less, you had negative real rates, which is unprecedented. And so it's difficult to argue they didn't get rates too low, I think, at least in my opinion. It was a very strange period, and they were much more worried about asset prices than they were everybody else, I think.
Correct. Correct. And that really, more than anything, I think, well, first off, it let them know that in 2020, when COVID hit, shut down, all of that began to take place, it let them know that their go-to was just print money.
Yeah.
And so their balance sheet, which was $800 million, and you can think of the Fed balance sheet as the money printing press, right?
Mm-hmm.
The bigger the balance sheet, the more money they've printed.
Yeah.
And it was $800 billion in 2007. They got it up to about $4.2 trillion by 2014. They didn't stop printing money for roughly really 6 years, 2008, 2014. They tailed it down less than $1 trillion. And then, of course, in 2020, exploded it to basically. We're now down some from, I think it was 8.9 trillion was the top. We're now down to 7 or so. So that's the extra money that they've injected into the system. And that pushes up asset prices, which is what they wanted to do. And that one period post-COVID, they increased the whole money supply in the United States something like 42% in less than a year. And you just can't do that without some side effects.
Milton Friedman had it right. Too much money chasing too few goods is how you cause inflation. And it works every time, unfortunately.
Right. And you throw in a little crimp on supply and boom, it goes to 9%.
We learn the lesson, it seems, every 10 or 20 years, but it seems like. But it's a very difficult problem to overcome. And then, sometimes the so-called cure is worse than the problem, which I think is exactly what happens.
Amen. Right? Ask any cancer patient. The side effects sometimes are worse than the disease.
Yeah.
But that's the roots of what I think we've got today.
Yeah.
So you had a Fed that was very, very reluctant to increase rates when they should have. If this has been 1994, the Powell Fed would have increased rates probably in early 22. Mm-hmm. And they certainly, what people don't realize or maybe don't remember, is that inflation crossed 5% in the CPI, and they were still subsidizing the mortgage market and still growing the balance sheet. And so they were, probably 6 months, maybe a little more late. And so that's the reason inflation wasn't transitory.
Yeah, that's right.
But now what I think you've got going on, and I think this is, so that's kind of the roots, right? This is how the tree grew so big, yes. Right? Is that it has those kind of deep roots going all the way back to then. Now you've got, and back up a second, that can't go on forever. Right. Because, and what Jim Grant says, if something can't go on forever, it won't.
That's right. That's exactly right.
And it can't. And so you looked up in 2023 and probably in fiscal 2024 for the government, and you have a $2 trillion deficit, right? And now that, as you said earlier, interest rates are back to slightly below average, not high, but slightly below average, and the interest bill for the government approaches $1 trillion.
More than the defense spending.
Exactly.
Exactly. It's a real burden, and it's a real cost. I think that we've kind of been lured into a false sense of security because it just kind of is off in the magic land where it just gets paid, but it's starting to really impact not only the deficit itself, but markets and other expenditures. And now I think that bill is coming due, whether you like it or not. At some point, when the credit card limit has been reached and you're way past that, the spending has to go down.
Yes.
And it can be painful. And I think that's exactly what we've been experiencing, both in the real economy and in the financial economy. And people don't like pain. People don't like change either. But these are times that are, I think you would agree with this, unprecedented, really, certainly in our lifetime. It's just been kind of shocking what we've seen, I guess, over the last few months after the Trump administration came in. And the big shock was he's actually doing some of the things he said he was going to do with tariffs and and holding the line in a few areas. And that seemed to really rock markets, I think. I don't know. Well, frankly, we're still trying to figure that out. I watch every day, and it's just interest rates are volatile, stocks are volatile, everything's volatile. There's so much uncertainty. So
Sure.
yeah, let's pivot to that and just tell us what you think about that, and where can we find some peace, Charles? That's what we're thinking.
Right.
Cash, maybe, right?
So yeah, no kidding. So I think this is kind of the first stage of kind of a bigger deal here, and a lot has been said out loud. A lot will not be said out loud, which is probably a good thing. But number one, the government and the Fed, who's ostensibly independent, but they're not.
No.
They're not as independent as they
Much
insist
less
they are.
independent, I think, than they
Right.
used to be.
That's right.
They're a lot more
And
political than they used to.
Yeah, they protest a little too much on that
Yeah.
part, right?
Yeah.
But they let the leverage in the system grow to the extent that it has, meaning owning of treasury bonds by leveraged pools of money, call them hedge funds, private, whatever you want to call them. They let that grow to the size that it is, 2 to 3 trillion maybe, because they were the buyers of the debt.
Yeah.
And they had to get the debt sold because Congress was spending it like a sailor. So that's got to get reduced. Now I think the real plan here that's kind of operating behind the scenes is you get a change in the tariff structure. So other people aren't tariffing our goods as much.
Right.
Right. So you at least have a fighting chance. Now, we're not going to be making socks in Fort Payne, Alabama anymore.
Yeah.
I mean, there's a place in Guangzhou, I think, that makes them for a quarter,
Yeah.
25 cents per pair.
Right.
Very high quality.
Yes.
And that used to be done in Fort Payne, Alabama.
remember
It's the
that.
sock capital of the world,
And
right?
textiles in Georgia, where I'm from, and
Right.
also furniture in Mississippi around Tupelo.
Right.
Yeah, those things were, when we were younger, that's what you saw, is a lot of
Exactly.
manufacturing of those low tech goods.
Yes.
And
That's not coming back.
I think you're
And that's
right.
probably best made
Right.
where it is.
Yeah.
However, it's the other things to do with technology and some other things that where I think there's some real value add, right?
Yeah, right.
The chancellor here told us again today that there's almost $7 billion in new construction projects, commercial construction, going on in the state of Mississippi right now. Used to be the average was 2.5 a year.
Yeah.
Is what he said. I don't know where he's getting the data, but I get it. I see
Yeah.
what he's saying, and
Yeah.
it's a great benefit. But that's the kind of manufacturing that needs to come back here, or needs to be built up here.
Yeah.
So I think that's the first goal. The second goal is taxes, right? They're going to go after this tax package. You're now in the real sausage making part of that process, right? Do you raise taxes on people making more than $1 million a year? Do you take away the tax-free status of credit unions? Do you take away the tax-free status of municipal bonds, right?
Yeah.
They're going to do some very dramatic things.
Do you make people repay their student loan? It's kicking in next week.
They have started that, right?
Yes, they have. Yes.
And there's a reason why that debt's not dischargeable, right? So I think that's kind of the second step, and I think the markets have got to deleverage to weather this situation, and the events of the last 4 weeks rather are probably the first breeze of that storm,
Mhm.
and then there's going to be a lot of ups and downs, a lot of volatility to follow. What volatility does, though, is it reduces leverage.
Mhm.
And that's what's got to happen. And so, I mean, that's why you had a 23-time, pick your measure, 23 times trailing PE on the S&P 500, right?
Right.
As opposed to 19.
Yeah.
Was because
or
leverage.
16 or 14.
Right,
Yeah,
which
yeah.
would be more important. One interesting thing about this, though, is that the default case of most people, and I'm kind of thinking this is probably right in the short term, is going to be stagflation, lower growth, higher inflation. You were getting higher inflation anyway. That was in the pipeline. I mean, you could see it in all the sentiment indices that prices paid were going up and so forth. So that was coming. We're going to get into the blame game of the economic weakness.
Sure.
Because Donald Trump's going to say if Jerome Powell had cut rates, this wouldn't have happened, right? Powell's going to say if he hadn't raised tariffs, we're going to get into that he said, she said stuff.
Yeah.
So that's coming probably as the next step. But that volatility is going to increase when you get into that. Now, what's so interesting is that of all the financial commentators on CNBC, Fox Business, whatever, vast majority of them, I don't know, 80%, say have been saying for 2 months now, the Fed should cut rates, the Fed should cut rates, Fed's too high, Fed's too high. The minute Donald Trump said the Fed should cut rates, 90% of them reversed.
Yeah.
So
he has that effect.
He does. He does. And it's kind of humorous to watch him. But I think what's going to happen here is you're going to get into that stagflation, and that's becoming the base case of certainly Wall Street sell-side prognosticators, economists, and large pools of money do their own in-house research, right? And so when you get to, you say, okay, that's our base case is stagflation. What do? Well, the first thing you do is you sell your bank stock, right? I mean, that's point number 2 in the deflation tab in the playbook. So bank valuations have suffered, and when I was in a bank board meeting yesterday, and we have a $645 million loan pipeline in an $8 billion bank, and they're all over the Southeast. So I don't think we're seeing a lot of weakness in banks, but the stagflation world punishes bank stock. And so we're going to go through that for a time. We probably are going to, if they can get this tax bill passed by May, which is an aggressive deadline, which they may meet. I mean, there's a lot of egos you got to satisfy here. If you can get that done in May, then in the fall, they're going to really go after the tax code. I mean, like the guy who's, I forget his name now, who's the CEO of Apollo, put it in the New York Times in January. Then he's advising the Trump administration, here's where we're going. If your top tax rate's 39% or what is it, 37.5%, whatever it is today, your effective rate, because you're giving all this money to Ole Miss,
right,
is actually somewhere
like 21 or something.
in the 24% range.
Yeah.
Right. And so take out the deductions, drop the rate to 24, simplify the code. Now you gore a lot of oxen doing that.
Indeed.
Right.
Yes.
Including the meeting I just left here who's trying to raise money. Right. So at the end of the day, that's probably the heaviest lift. But underneath all of this is going to be running in the background deregulation. And you can't see it right now. But I think that at some juncture, you can see the stats, the small businesses spend X amount on deregulation, et cetera, et cetera. If and when that, I think you got to deleverage the markets first before things can calm down. And you're seeing about once or twice a day, you're seeing this hedge fund lost 50%. So these guys are blowing up, right? Yeah. And which is one thing that's interesting. We talked about this at the banking thing. Post 2008, Dodd-Frank made the banks and investment banking firms on Wall Street move all of that speculation out of the house, right? So what happened? Their people left, started hedge funds, and then Wall Street banks lent them the money.
Yep.
And so all you got to do,
you just put in an extra step.
Exactly. So it's like that scene at the end of the movie Trading Places, right? Margin call, gentlemen.
Yeah, that's right.
I mean, it's time to pay the piper. So that's what's happening right now. And that volatility causes those margin requirements to increase, which shrinks that leverage. So I think you've got to get through that before things can calm down.
Yeah. The tariff situation is interesting because most of the analysis that I've seen, at least in the popular press, the financial press, and we economists would do this too, although I'm a financial economist, not an economics guy. But
economist.
Not an economist. But we typically look at changing one thing at a time. So tariffs come on, what does this do? Well, there are many other possible and in some cases actual offsetting effects. For example, exchange rates,
right,
interest rates, raw inflation, reduced profits. Those are all possible reactions to increased tariffs. And we've seen over the last month, really, all of them. And then they've reversed. Interest rates went up, fell, and then went up and then fell again. So that's that's about, I don't know if I got that sequence right, but it was about like that.
Close enough.
And the currency rates, when the tariffs first went on, there were some currencies that fell 20% with a 20% tariff, and we in America would be level. So you go, okay, well, it doesn't impact us very much. It's going to impact the foreign country.
Totally.
And so that's something I don't think people thought about initially. And then
No, they're not.
Yeah.
And that's what made me angry initially, where everybody drew us just a straight line. If
Right.
you increase tariffs X%, your prices go up that same percent or something like that.
which is not true.
It's not true.
Yeah.
No.
And then the other piece, which I've heard almost no one talk about, is there are some, whatever you want to call it, but there are some defense sensitive things that, and maybe even things like pharmaceuticals that we need to make sure that our pipeline is good here,
Right.
regardless of these things.
There's some real use for this.
Yeah,
Yes.
and so that's something that no one was talking about.
Right.
And when I heard on the news the other day, I don't remember the exact number, but over 90% of our pharmaceuticals were made not here.
The precursor elements,
But-
yeah.
And then the rare earth minerals this, and we're not going to have the byproduct to create the chips and things like that if we're not careful. So it's not just financial assets have gone down in value.
Right.
There's a lot of secondary and tertiary effects that are very important.
Yes.
So I think that this is not, and by the way, another point too, Trump didn't just start thinking of this last week. I saw a video from the 90s he was talking about tariffs. So this has been on his mind for a very long time, at least 30 years. And, I'm not sure how it will shake out. And he's run, out of 12 plays, he's run 14 audibles. So I'm not real sure where we'll go, but he has definitely created a situation where markets are confused, and that creates the volatility, turmoil, and adjustments that.
Well,
I
that's
think
where
people struggle with.
that's why I think the first part of this discussion is a little more germane,
Yeah.
is because the minute things didn't go so swimmingly, right, and you didn't go from 23 times earnings on the S&P to 24, right? With the minute that didn't happen, everybody's screeching for a bailout.
Yeah.
Right. Remember that week Treasury
Yes.
yields went up about 40, 50 basis points.
Yeah.
Where's the Fed? They have to step in. There's no liquid. The plumbing's broken. I always
Yes.
love it when they say that.
Yes.
The plumbing's broken. It means they're trapped. And so at the end of the day, when the dust settled, we were still not at the high rates for the year.
Yeah.
First week of January, interest rates in the Treasury market were higher than they are today.
And I looked before we came in here, the interest rates dropped 15 basis points in the last probably 2 hours. So it's all over the map. It really is. So what would you tell, let's suppose some of our students or recent graduates are watching this, and here we are. I would call us grizzled veterans, but that I don't know what that means anymore, right? But what would you tell young people in this environment? Should they just pack it up and go home, or what should they do?
Learn to code?
Learn to code, or it'll be like a kidney stone. This too shall pass, right?
Well, what I would say is that this creates opportunity, right? In that, I think you're really seeing a reordering of the financial system in the U.S. And you've got to get away from several things. One is relying on the Fed to do what they're doing. Second thing is relying on government spending to always go up.
Yes.
But one thing that's been forgotten along the way is fundamental analysis, right? Mm-hmm. Because you look at, really, I think you can probably go back 15 years and you can look at momentum versus value investing, let's say, or growth versus value, however you want to put it. And value and fundamental investing has lagged.
Yes.
Well, what happens if that comes back? Yes. Right? And you need people with the ability to do the research and understanding. ChatGPT and Grok are not going to replace that. Yeah. Right? Because they're great tools for somebody in that world. My son's in that world. Yeah. And he knows how to use that much better than I do. The farthest I've gone is the dictation function in my Outlook.
I understand. I've looked up golf courses. That's about all I've done with it. And it is pretty good at that, I will say.
But I think that's where one of the opportunities is going to be. Mm-hmm. We've still got imbalances in the economy that have got to get evened out, right? Yeah. Housing is still one of them. And, the federal government subsidized housing for easy 20 years because it really started in 2006. Yeah. And so with Fannie and Freddie, everybody needs a home 1% down at Ginnie Mae, all that stuff,
Yes.
right?
Yes.
And I remember we had unfortunately planned a trip to Dubai and Riyadh in 2008. We planned it in January, had to get visas and everything, and we ended up in Riyadh speaking to a group of Saudi bankers the first week of October 2008.
Oh boy.
Well, they wanted to know what the heck is going on.
Sure.
And at the time, I certainly didn't have the perspective we have today, but the best I could come up with, try to get them to understand, is that Fannie Mae, Freddie Mac, which their power was way beyond what we understand now back then. Their job was to get everybody into a house they could.
Oh, it was a stated goal by the government and both Freddie and Fannie. Absolutely stated goal.
And they bent every rule in the book that you would teach in a credit class.
Absolutely.
Right?
Teaser rates, everything.
And one of the Saudi bankers, I'll never forget, looked at me and said, "Why?" He's an older guy, been a banker forever. In their world is a little different than ours, but yeah, they broke all those rules, right? And you don't break those rules without consequences, right? Because your 5 C's of credit or whatever it is now, it's probably 8 or 9, but
at least 5.
Yeah, they're there for a purpose,
yeah,
right?
Yeah,
and so that seed got sown, and for the next 15 years, you really had a housing shortage, but you subsidized it the entire time, particularly after COVID.
Yeah. I
mean, all 3 of my kids got 3% mortgages.
Yeah.
Thank goodness they did.
Yeah.
Right. But now they're kind of locked.
Yep.
So anyway, that's another imbalance that's got to get righted. And I think it's got some time to go. But I do think that on the other side of this, if you can get the markets delevered, if you can bring value investing back, and if you can just bring saving back, I mean, that's one thing that's been missing from the debate. Is all that time with all that free money, the inequality, financial inequality in the economy skyrocketed.
Sure.
And Janet Yellen, as head of the Fed, who I'm no fan of, kept saying we got an equality problem. In the meantime, she was sitting on interest rates at 0.
Yeah.
And so the way to solve that is a 6% savings account, right? Could you imagine?
Yeah.
But if you got 6% savings account, you're going to have 9% mortgages. Right? Or thereabouts.
Yeah.
And to have 9% mortgages, you're going to have house prices come down.
Yep.
Because the same things happen in the housing market that happen in the stock market is the leverage got subsidized. So anyway, that's a terrible answer to your question, but bottom line is this is a major change that will create opportunity. Because as you mentioned a minute ago, certain people, they don't know how to operate if rates aren't 0 or near.
Yeah, that's right. That's right.
So that I think is one thing that's going to bring about a lot of opportunity.
Well, we'll probably end it there. I think we could both. I know you could go for 8 hours. I could go for 4 hours, but I don't know that we've got enough stamina.
We ought to say one more thing though. We ought to talk about banking regulation.
Sure. Yeah. Go for it.
I think that. And by the way, I've texted Mickey Bowman about her son coming to Ole Miss. So
Fantastic.
Now the parent of an Ole Miss student will be the vice chairman of the Fed.
That's right. That's fantastic. Yes.
Which is great. But I think under her guidance and the guidance of the rest of the team, banking regulation is look like something we've never seen. And it's going to be much more logical and much more focused on a healthy system rather than just protecting the deposit or the deposit insurance fund.
Right.
And you don't really know the extent of that yet. It really hadn't made it to the field level. Yeah. It's still going on in Washington.
Yeah, I mean, to me, the easiest way to approach that from anybody, whether they're a banker or not, is look at a HUD statement when you sit down and get a mortgage. There is no disclosure. No one reads that. It's 200 pages or thereabouts.
Good
Nobody's
point.
going to read that. So if you want real regulations that matter, create a 6-page document that you've got a shot that somebody will.
Yeah.
They're not going to read 200 pages.
No. What was it you said? I think you said it, that a complex regulation empowers the regulator. A simple regulation empowers the operator.
That's exactly right. You need to be able to, there may be a rule that said no regulations can be more than 4 pages. That would be helpful. But we could definitely could streamline things that would make banks much more happy.
I don't know if you go as far as getting a merger of the OCC and the FDIC or one of them absorbs the NCUA.
Yeah.
But I think it might be that deep. I mean, that's a big
It'd
possibility.
be a huge change. But,
which I think would be great for banking.
yeah.
And so for somebody looking at a career in banking, normally a non-entrepreneurial business,
Yeah.
looks like it might become very entrepreneurial.
Well, and compliance will never go away, but I hope that
Right.
the burden will be reduced so that banks can be a little bit more competitive. That would be wonderful.
Exactly.
And,
That's
and it
exciting.
sounds like we're moving in that direction.
Yeah.
So, yeah.
Yeah, you're always supposed to end on a positive note, right?
That's
So
right. There you go.
That's exciting.
Well, Charles, thank you for this time. It's been great, and I've really enjoyed it. And I know that our people that are watching on the vodcast here will enjoy it too. So thank you so much.
You got it. Thank you, Ken.